Hello and welcome to our continuing series on passive real estate investing. Today's topic is part 6 by Due Diligence. Joining me today is the uncomparable team of John Rubino and David Rutherford. They are incredible in terms of multiple aspects of real estate and are going to be sharing with us their wisdom today. Also, we'll let you know, guys, we do have the prior recordings of this available, and if you want to check out the prior recordings, please let me know. That we will be including that in the description of the YouTube channel here as well. So if you're interested in that, that will be in the bottom of the YouTube channel, and it'll have the playlist itself. All right, John. Without further ado, I'll go ahead and turn it over to you.
Hey, thanks, Doug. Appreciate it. Everybody's got the screen, I'm assuming. If you don't, just let us know. But you should see that on there. And
Looks
again,
good.
welcome. Thanks for joining us today. Today, we're covering part 6 of our 7-part series on passive real estate investing. So today, we're going to talk a little bit more about due diligence, dig into it a bit. We're actually going to show you some documents that we're going to discuss briefly. But yeah, it's pretty exciting. This is kind of when you're getting into a lot of the details of a project that you've kind of committed to or you're thinking about jumping into. And so we just wanted to share some of this information so you kind of have some tip of the iceberg type things to look at. And of course, we're going to share our contact information at the end. So if you have any questions or you want to reach out to Doug, Dave, or I, feel free to do so. Our slide here, obviously, we've done this for a while, but at the same time, there are areas that we're going to talk about that we don't give guidance or we don't give direction. So if you've got an attorney, you've got your accountant specialist, you're going to hear things about taxes and everything that we know about as far as how we've experienced it, but by no means are we licensed professionals when it comes to those areas. So please reach out to those professionals as they may be dealing with your specific situations, given where your state is or how taxes are handled in your jurisdictions. Okay. All right. Oh, there we go. So you got Doug, Dave, and I on here today. A little bit about us. Doug's been the chief investment officer for his company, Eagles Flight Investment. He handles a lot of law practices. He's got a great expertise in marketing and due diligence. So Doug's obviously a great person to have on here today. Dave's been with our company, JID Investments, for the last 2+ years. He is prior Army, and you see I'm prior Navy, but Dave and I get along pretty well considering. So he's a fantastic asset and team member on our group. He was brought on to handle our Juniper Square portal, which basically is our investment portal to help our investors see their deals and manage their investments through our company. And he's quickly become our director of investor relations, handles a lot of the marketing updates and reports for our company, and does a heck of a job. I call him my right-hand man. And then I've been in real estate for over 18 years now. I served in the Navy for 20 years. I was a Navy pilot. I retired back in 2017. JID Investments has been up and running for 10 years plus now. We've invested on 30 projects to date, going full cycle on 18 of those projects. We've made money on every one of those, and I'm knocking on my desk here. And we've got 12 active deals right now that we're investing on. So across the entire portfolio of 30 projects, we've invested close to $40 million. And we've got about 225 to 250 investors. And we are capital raisers. So we typically raise money on a project-by-project basis for our sponsor partners, who are the ones that are actually out there doing the build, the operations, the management, the oversight of these projects as the active portion. So we help raise their equity and their capital for the deals that they're out executing. So go to the next slide, which we're going to talk a little bit about the difference, and we'll stay on this briefly. We covered this pretty much in depth on the first part on your team, but the purpose of this webinar is really we want to get back to friends, family, colleagues, people we know, people that are interested in investing in passive real estate investment. There's an array of different ways to do this. There's different groups you can invest with. But if you have an appetite to want to invest in real estate, but don't have the time or don't want to deal with the headaches of having tenants or being an active owner, passive investing could be something you could take a look at. So we wanted to just give you some insights into how we do it, how we see it, how it's been successful for us, and just want to pay it forward. The difference really between the active and the passive is, when you're active, you own the property. You either take on a bank loan or you bring in all the money to buy it, to operate it, to oversee it. You call the shots, and it's your property. So that's the pros, right? The cons maybe is I got a full-time job. How do I manage this property? Will I do my 9 to 5, my W-2, or run my company? Or, hey, I'm retired now. I don't want to deal with this anymore. So, it's really what your appetite is. I've got several friends and colleagues that have 40, 50, 60 portfolio properties, or guys who have, 10,000, 20,000 doors as far as apartments, and they love it. And they've got a great team, and they do this, but they do it 10 to 15 hours a day. And so if you don't want to do that, or you just don't want to take on the headache or the liability, or the just, the day-to-day grind of it, passive real estate investing may be for you. So something to think about. And the benefits of passive real estate investing really is, again, you get to enjoy it. It's kind of like, it's similar to looking at a stock market investment, but it's obviously more detailed. But you get the chance to really enjoy seeing how your investment does. You can get involved as much as you'd like, where you look at the due diligence and you're doing the research and you're talking to the teams that are out there investing, and it's very hands-on. So you can be as hands-on as you want, or you can be as hands-off as you want when you get into passive real estate investing. And that last bullet there is, yes, it is very worth it. I've told people numerous times, I feel that the next 3 to 4 generations worth of our nation, and in the world for that matter, is going to probably grow a lot of their wealth through passive real estate investing or passive investing. Again, there's other avenues to look at. If you like energy, you like currency, you like precious metals, you like anything else that's out there, obviously that's passive as well. But real estate, that's our neck of the woods in our game. So that's what we stick with. So with that, we'll get ready to go. The first slide here is really a kind of summary of the 7 parts of this series. I'm actually thinking about making it 8 parts and bringing a sponsor in on that 8th part to possibly talk about looking at a deal from their perspective. Obviously, we're passive, but we still have to understand how the sponsors do this. So we'll see about maybe bringing on a sponsor. So the first 6 parts you could see, first 5 parts we've covered, and it's kind of a nice order when you're looking at doing this. The first part was your team, who you put around you to be successful, and that first person on the team is you. So once you kind of you're involved, and then you got to go out and bring those smart people around you, along with your smarts that know things differently or in other areas that you're just learning about or maybe are new for you. The second part, very important, is how do I find a sponsor or a business or a company that's going to bring me an investor, or bring me, a deal. So what do I look for in those sponsors? How do I determine if they're a good sponsor? So these are the things we covered in part 2 in depth. Part 3, which is the next step kind of in the way we look at it, is the location. And I say location, location, location. It's pretty much right next to the sponsor. Because if you got a great sponsor, but you're in a terrible location, that may give you a thought to say, well, I'm not sure why are they in this market, or what makes it stand alone or stand up to the fact that they like to invest in this market. The other thing is you may want to be in a market that you live close to, within an hour away from your property. You may not want to invest in Texas if you live in California, or if you're in Florida, you may not want to invest in Boise, Idaho. So these are the different things you think about when you're doing looking at the location. Part 4 was the asset class, and an asset class is really the type of investment. Is it multifamily value-add apartment? Is it opportunity zone land development? Is it condo development and new construction? Is it mixed use? Is it student housing? Is it storage? Is it senior living? Those are the types of assets that you want to look at to see your comfort level. And we'll talk a little bit more about that today as we dig into due diligence. And then the 5th part, which is important, is where's the money? How does the money come into play? And that's kind of where we focus on a lot of our efforts with our company as capital raisers. We're looking at how does the money come together? How does the bank come into play? How much money is the bank coming in for the amount of money it's needed? How much money is coming in outside the bank? And what happens if we need more money? What happens if the sponsor comes to me and says, "Hey, I need you to bring in more money"? What are my legal rights, or what are my kind of privileges in the deal that tell me, "Hey, no, I don't want to bring in more money, and here's where it says I don't have to." So, we'll talk more about that. But the money is a very important part, from bringing the money in for the project, for the execution, the operations, whatever it is, to how does the sponsor get paid on his fees or her fees, to what are property taxes and insurance. So that's kind of looking at the holistic portion of the money. But when you talk about the capital stack, you're really focusing on how the money is being put together and brought in for the project. So I'm going to take a quick pause before we get started on part 6. And I see a couple of comments or questions, and we can go through those, other than Andy saying hi, but I don't think we have any. Does anybody have any questions, any comments before we get started?
I want to say thanks, John, for running this.
Oh, my pleasure, Andy. We got Keats on, another Hawaii native, so you guys need to connect afterwards. All right. Well, if there's yeah, no problem. If there's no other comments or questions, we'll jump back in to part 6 for today. And so, due diligence. Everybody hears that word and they're like, "Oh, what does that mean? It's a headache. I gotta dig into this now. I gotta figure out, what I want to do. How do I do it? How do I protect my money? How am I going to make good returns? Is this a good project? Can I trust these sponsors?" And these are the millions and millions of things that are going into your head when you start getting into passive real estate investing. But just like with anything, you want to put together a nice plan for yourself, right? Get yourself situated to say, "Hey, I want to do this. I'm excited about doing it. And these are the things I need to make sure I do." Being in the Navy for 20 years, we lived and died by checklists, and I still have them. And so you're going to be putting together checklists. You're going to be putting together outlines on how you look at deals, how you interview sponsors, what are the questions you ask them, how do you kind of position yourself to find the right sponsors that you're comfortable with. Okay, so let's first start with the first part here, which we kind of covered in part 2, which is the sponsors, right? So when you're doing your due diligence on the sponsors, there we go. I like to put up red flags. What I like to do when I look at a deal is I want to say to myself, what is going to not want me to do this deal? And that's how I go into looking at a project or a deal. And if I get through that entire due diligence and I can't find the one thing that really burns me or is a red flag, then I'm probably going to like the deal, and I'm going to probably do a little bit more detailed research on it. But these are some of the red flags on the first bullet you need to think about when you're looking at a new sponsor and a new group that you want to invest with is what's their experience? And it's not just how long they've been doing it, but are they in a new market, right? If they've been in Florida and been doing really well in Florida, and then they turn around and say, "Hey, we're going to do a deal in Chicago, and we want you to be one of the first investors in this new project in this new market." I don't know if I'd want to do that. I'd say, "Hey, come back to me on your 3rd and 4th project when you do real well in Chicago, like you're doing in Florida." Or, "Why are you going to Chicago? What's up with Florida? You guys are doing really well there." A lot of things we've been seeing lately with some of the experience questions or issues is that some sponsors are doing too much. They're getting overwhelmed, but they're trying to keep that boat going because they want to keep bringing deals in. Well, again, you got to be careful when you talk to these guys. Ask them for their financials. Ask them, "Hey, how come you're doing 30 projects or 20 projects right now? Are you having challenges with what we're seeing in the economy? Are you over leveraged with the bank debt you got? How much money are you guaranteeing?" So these are some of the things you can think about when they're starting to do more and more, because I can promise you, if they got 20 projects right now, I would say there's probably 2 to 3, maybe more projects in that 20 that may be having some challenges with interest rates or with bank debt or with occupancy percentages. Those are the questions you want to ask them. The other thing is you want to make sure that the stuff they're sending you is correct or accurate, right? They're underwriting, their performance, everything is correct and it's professional. It's not sloppy. thrown on a spreadsheet with where you have to go digging and finding everything. And I'll show you kind of some examples of those today of ones that look really good. Lack of communication. I cannot stand when a sponsor doesn't get back to me if I've asked them a question or I sent them an email and it's been more than 48 hours or 72 hours. And if I go back to them again and I don't hear from them, that's a red flag. I need communication because I'm a capital raiser. I need to keep my investors informed, but just when I take off my business hat and put on my investor hat, because I invest in my projects, I want to know too what's going on these projects as an investor. So communication is very important. Assumptions are very dangerous. So make sure that you don't assume that if you have a question, ask it. And I'll tell you now, there is no stupid questions. If you think you have a stupid question and it's not asked, I bet you there's 100 other people that want to ask that same question. So don't be afraid. And of course, it's your money. So you guys have to realize that you got the right to ask whatever you want. And those sponsors should be able to answer to the best of their ability. And then again, like I said, with communication, not getting what you want within a reasonable hour, 48 hours, if I'm not getting back information or I'm getting piecemeal stuff, that's a red flag when I'm doing my review of sponsors. Fees, it's nothing wrong with a sponsor getting paid to do their work. They get paid fees inside of what they're borrowing. They get paid fees for executing the project. They have to make payroll. They have to pay their employees. They got to pay the architect. So that's fine. I'm a big fan of performance-based fees, meaning that, hey, if you accomplish milestone A, you get a portion of your fee. If you don't accomplish milestone A and it's delayed, then you don't get paid until milestone A is completed. So I'm fine with fees, but if I see somebody's getting, 5% for a development fee, and that's all coming in at the closing, I'm saying to myself, okay, that's an issue. We got to revisit that. And then also, obviously, skin in the game. I want to make sure my sponsors have money in the deal, just like I want to have money in my deals when I bring them to my investors. And a lot of times you'll see a sponsor say, hey, I'm going to roll my fee into the deal. Okay, well, if you're not going to get your fee until the third or fourth month of the deal, then you're not really bringing in money. So I like to see real capital. I like to see them taking money out of their pocket, just like I am, to bring into their deal. And then a couple of other bullets, you want to make sure that you take a look at their legal documents, make sure it makes sense. We'll cover a few brief things on there today that you can go through to really pay attention to. Again, we kind of mentioned unsatisfactory underwriting with just kind of unrealistic numbers and correct numbers. Key team members, you want to make sure you know who the general contractor is, who's the engineer, who's the architect. Do a little research on those folks. And last but not least, you want to make sure you talk to some references. Ask the sponsor, hey, can I get 5 or 6 of your investors that have worked with you on multiple deals? And is it okay if I reach out? And if they say no to that, thank you for your time. I'm going to move on. Okay. So that's the sponsor. The next one is going to be your location. And I'll get through this briefly. These are some, and again, this will all be available to you. These are some demographic sites that I love, that I go to on every deal that I do. And a lot of this information I use to build my investor deck or my presentation, my summary. So a lot of these sites are really, really good. I'll just bring you to one of these, Data USA, and it's really easy. You just go on here and, you just type in, the city. So let's say you're going to invest in Charleston, and it even prompts it up for you. Like, I spelled Charleston wrong. Yeah, I'm really good at spelling. Charleston, here we go. South Carolina. And when you go there, it's going to load all the data. And it's going to bring up things like demographics. It's going to bring up, median income. It's going to bring up jobs. It's going to bring up, all the percentages there for property taxes. I don't know why it's not coming up. It's not making me look good here, but that's all right. We'll go to another one real quick and I'll show you. This is another one I like, Niche. Niche is a good one too. We got a project in Frederick, but look at that. You go to Niche and you get some rankings here on the report card on how it kind of rates that market. So overall it's an A-, but you can go in here. Housing's a little weak, but it's growing, I can tell you that. And then it gives you a nice write-up, gives you the population, gives you all this details. And then if you go down, it shows you the map. And then you can also look at where it ranks nationally and in the state, which I really like because I can dig in on that and do some more
Hey,
research.
John, if I can just stop you for a second.
Yeah, Dave.
We as the audience can't see your screen right now. We can
Oh,
only see the slide.
I'm sorry. Let me do that. Dave, you should have jumped on me sooner. Sorry about that, guys. So I was showing you guys niche, and I apologize. Let me just type it in real quick. So yeah, niche. Here's Frederick. I was showing you guys this. This is kind of all the details you could pull up, and I really like it because again, it gives you all the details and information: colleges, universities, where it's located, where it ranks in the state. So another good one that you could look at. And can you guys see my screen again? Dave, you guys see my screen, the location? Yeah, okay, good. So that's kind of some of these good websites here. The other thing you want to look at in the location is we talked about this before, what's the supply and demand? If you're going to do a storage investment and there's 100 storage units near where you are, probably not a great place to maybe do a storage investment. But those are some of the things you want to look at. What's coming into that area? What makes it attractive for housing? And the next bullet kind of covers that: jobs, access, where the airport's located. Does it have great restaurants? What am I going to do when I'm not working? Can I go out and have fun with my friends, go to cool restaurants? And then, what's the income? What's the earnings there? What are the wages? That's a big one. Another good one I like, and you guys can click on this one. I won't do it, but BizNow. These are all Urban Turf and BizNow are websites and companies that send you reports in your market. So if you choose DC, it'll send you a daily email on the top 10 stories in DC, which I love. You can click on and see. Some of them have some of the sponsors we work with, so I can actually see some of the cool stuff, and we include that in our emails and updates to our investors. So you can sign up for some of these, and you can get these each day, and it'll give you some great information. And then on the bottom here, you see these are some groups. It's always great to be in an investor club or group if you can find them, especially if you are going to do this and do a lot of it. LFI is Left Field Investors. That's a group that we know of that's out there. Bigger Pockets, I'm sure a lot of people have heard. And then there's some private investor clubs you can look at. There's a group called 506 Club. You can check them out. But yeah, I mean, that's something you could do a little research on. What's nice about that is you got like-minded folks. You might be able to find some mentors in there, people that are doing it. And then sometimes they even have mastermind groups where you guys can come together and invest on a deal, which is pretty fun. So that's something to think about too when you're looking at location and you're looking at, getting into specifically the markets that you want to invest in.
Yeah, John, if I could add, networking, the Zoom meetups, and a special plug for Emma Powell's meetup. She is especially suited for folks that want to, learn from passive and learn whether or not passive or active is good for them as well.
Yeah, very cool, Doug. I agree. There's a ton of groups that meet, like Doug says, weekly. We're happy to pass some of those on. Brian Briscoe has a great group. There's a couple of others too that we're happy to share with us, so you guys can check those out. The last two are your asset class, and again, it's what you're comfortable with. Some folks that want to invest and get cash flow because they want income like to invest in value add, which is an apartment complex that's existing. You have a sponsor going in. They're going to either replace management. They're going to renovate the apartments, the units. They're going to get the occupancy up so the more people are there. The rents are going to go up if they make modifications and remodel and rehab the units. They get a better property management team in there for more efficiency. So they could take a building that's operating at 70% efficiency all the way to 90, 95 and improve the cash flow. And so on an investment like that, you're going to get monthly or quarterly cash payments on your investment. And then you're also going to be able to get depreciation losses, which is great for taxes, right? So you're getting cash flow, you're getting depreciation write-offs, and then you're going to also get a portion potentially of the appreciated value of the property. And when the sponsor exits that property, say in 5 or 3 or 10 years, you're going to also get a bump up in your profit and your returns from the sale of the property. So there's a lot of benefits there on a value add if you're someone that wants income and let's say you're retired or you don't want to be in a W-2 anymore and you want to just really be a professional passive investor. Value adds are very strong. Now, the downside of value add, and again, this is just from my perspective, is that the cash flow you make is treated as income, right? So that's going to add to your income tax. And then the depreciation loss is fantastic, but don't forget, whatever the government giveth, they shall take it back. So you get recapture gain on the back end. And then whatever profits you make on the back end, that'll be typically treated as long-term capital gains, especially if it's not paid to you until after a year that you're in that investment. So value add is a nice investment if you want to get mailbox money, which is what we call it. If you want income, if you want a safe asset, because if you're walking into a building on day one, it's not raw land. It's not something you got to build from scratch. There's a lot less liability. So the returns are complementary to the risk of the deal, which is my last point, risk. You got to look at what you're comfortable with from a risk perspective. Bigger returns mean you're going to be taking on bigger risk. Development deals where you got a piece of raw land, you're going to see 20, 25% returns. That's great, but those are risky. Those are very risky. You could lose all your money. You could have a worldwide pandemic hit. You can see interest rates skyrocketing. So the more risk you take on, the higher the returns, which we talked about part 5 of our series. But if you have, let's say, $100,000 and you take 20 or 25 of that, you put that into a more riskier investment, you're diversifying. Maybe you put 25 in value add, maybe you put 25 in another type of investment. But if you diversify it, you'll get the opportunity to, make better money. But again, just realize it's at a higher risk. And the last one on there, which is going to be part 7, is really your waterfall. And the waterfall, the distribution schedule is what we call it. It basically is going to be how you get paid. How do you get your returns? So we'll spend more time on that, but I'll give you some pointers. On a value add deal, you're probably going to see anywhere from, let's say, 13 to maybe 18% total investment return. And that would include what you get paid out on your cash flow. That would be what the sponsor puts in as far as their preferred interest rate return, which is basically the amount of money they've got to get you before they take in any profits for themselves. And then the overarching return when the property's finished and it exits is going to be a boat of money that's going to get spread out, and you'll get a portion of that from your investment. So that's how your overall return is calculated. But we'll get into that more in the next part. But I can tell you right now, if you look at these 4 or 5 areas, you will eliminate 75% of the deals that come across your desk. And I say that because it saves time. And if you spend about an hour, hour and a half, 2 hours on these 4 or 5 areas, looking at some of the stuff I've mentioned, and you're looking at sponsors or you're looking at deals, if you don't feel comfortable with one of these 4 or 5 areas, including the risk, then it's probably one you're not going to want to invest on. So that's why I wanted to cover it first. But let's say you go through it, you did your due diligence on those 4 or 5 items, you feel comfortable with the risk. The next thing you want to look at is what's called a pitch deck. And a pitch deck is what the sponsor is going to send to you, or the capital raiser is going to send to you, that gives you the insights to the deal. The name of the company, the entity, their experience, how they performed, where the asset's going to be located, how the capital stack looks, and then a little bit of a breakdown, tip of the iceberg of the budgets. What does your returns look like, and how they're going to pay those returns. So I'm going to come out and I want to show you, and I'll stop sharing just for a second and I'll reshare, but I want to show you an example of a pitch deck that is from one of the companies that we know. And this is a deal in Washington, D.C. It's an older deal, but you can see kind of what a pitch deck would look like, and get an idea of kind of some of the things that we're kind of talking about here. So let me share my screen. Everybody see that? 806 Rhode Island Avenue. Thumbs up. Good. So you get a nice picture maybe of the rendering. This is what this building is going to look like. That's what the architect's putting together. That's what they're going to submit to plans and permits. This is a development deal, 220 apartments in Northeast DC. Again, they usually do a disclosure, which is what everybody does. Again, do your homework, trust but verify. This is kind of a nice breakdown of what you're going to see in this pitch deck. Here's your contact information for the president of the business or the director of investor relations. These are the people you can reach out to talk to, where they're located. You get a nice executive summary. You get the property. You get an idea of what they're going to do, the costs, and then in this one you can see they have a 4-year return of about 27.5%, which is great because that means each year you're going to be making 27.5% on your money, and after the 4 years, you're going to see a 117% return on your capital. So whenever you see this equity multiple, an equity multiple basically is the percentage of what you're going to make on your overall investment. So the first number of the two here is the return of your money. So 1x, a 1x means I get my money back. Anything above a 1x is what I'm going to make on the deal. So if it's a 1.8x, that means I'm going to make 80% return on my money on that deal. If it's a 2.17x, that means I'm going to make 117% return on my money over those 4 years. So you're going to be making more than a 26% return. 27% is your IRR. So that's what you're going to be making on the deal. And then you can see here how they're going to split. This is kind of how they split the profits and the structures. So that's more the waterfall, but it gives you a little bit of a taste there. A little bit more information about the property and the location. You can see the composition of the project, which is pretty cool. Here's some amenities. This property is right by Catholic University in downtown DC, which is beautiful. And again, it gives you some more in highlights. Zoning, what they plan to do. So I just wanted to just show you. Here's a big one that I'm looking for. Here's the money. Here's the capital stack. You can see they're getting a mortgage for $39 million. They're bringing in almost $19 million in equity. And then they, as the sponsor, are bringing in $2.1 million, which is great because I'd like to see at least 10% of what they're raising coming in from them. And then here's the total cost across the board. $60 million project, 220 units. So this is the cost per unit, price per square foot. So this is all the stuff you're going to see on the deck. And then here's a breakdown in the returns. So you usually will see this. So this is a good project. You're making 27.5% on your money, and net equity return is probably taking out taxes most likely from this. So your net profit is 23.4%. Okay, this is a map. What's located. Again, remember I mentioned transportation access. What I want, what's making me excited about this location? That's the train, the metro, where the stops are, where they go. And then some more information about the market, which is usually at the end. And then the last thing you'll see here is they'll give you comps. So comps are basically, hey, how does this compare to other projects in the market and in the area? So this is nice when they include it. So you could do your research on that. But this is your pitch deck, okay? And I just want to make sure you guys saw one of those. JID, the way we do ours, it's pretty similar. This is a project we just we raised for on in Fairfax and in Charlotte, North Carolina. And we do something very similar that we send out to our investors that looks very much similar to what you just saw. So this is our executive summary. And then down here, we have all of the data and the details for the project and the demographics. So I just wanted to share that to everybody. And so let's go back into our slides. Does anybody have any questions, or are we tracking anything at this point, guys, that we see? We can take a pause there on the second wave. Going once. Okay. The third wave, the pro forma. Now you've looked at the pitch deck. You've got an idea of the deal. You've done your first wave due diligence. Now it's digging into the numbers, digging into the details, the data. And I know, Laura, you mentioned a little bit about this. But I wanted to show you all kind of an example of a pro forma. I'm going to go ahead and share my screen again just so you can see that. All righty. Sorry. Let's see. Here we go. Okay. So here's an example of a pro forma. I know the numbers are a little tiny, but you can see here, this is really nice because our sponsor here, they break out the project summary, which has, number of units, square footage, the breakout between 2-bed or 2-bath and 3-bed, 2-bath, 1-bed, 1-bath for the apartments, the parking, how big the property is, the timeline, right? When they're going to close on the land, there are major milestones here. And then in the middle column, they have, and I'll make this a little bit bigger, so I'm sure it's hard on the eyes. Here's the costs associated with the project, how much they paid for the land, the acquisition costs, the hard costs are what it's going to cost. This is a development deal. So this is how much it's going to cost to build it. Contingencies, or if, hey, things go over a bit on the cost. So there's your total cost. Here's all your cost per square foot on the land and the soft and the hard. Here's the funding. So they're going to go out, they're going to raise about 58% of that $46 million in bank debt. Okay, that's usually your senior loan. And then they're going to go out and raise equity from a large institutional equity group, usually like an insurance company or family office, a REIT. And then they're going to go out and raise private equity through their business of about 1.4 million bucks. Okay, so that's going to make up the entire capital stack. And you can see here they're leveraging about 58% of the cost with the bank debt. The bank likes that because the lower that number, the less money the bank has to bring in, and the more that they have the equity as protection against them in the event that the property forecloses or that the borrower can't make payments back. So basically, the bank's got $26 million in this project, but right now that project could be worth as much as $45 million and upward at that point. So all this equity here, this $19 million in equity, is kind of the shield for the bank to protect it in the event they have to foreclose. It's very important because you've got to realize that when you invest, is that if this number is like 80 or 75%, that's great. That means the bank's got a larger chunk of the funding. But at the same time, it's what is going to protect me if the bank's only getting paid back or only a portion of this equity is paid back if, God forbid, this thing goes into foreclosure or it drops in value. Okay. And then down here, you have some more costs associated with the project. On the right side, this is sales information. So we're going to hope to sell this project for $63 million, which would be wonderful. This is the profits after we pay off the construction loan. Then you got to take off the $19 million we showed you in equity. So that at the end of the day, the profit that's going to be spread out to the investors on this project is about $12 million bucks. And the sponsor's going to get their portion of profit, which we call a promote, of about $6 million bucks. Okay. And then this 12 million would be broken out by the members of the investment. So if you're let's say you're a 10% member, or let's say you're a 1% member in this investment, you're going to make $120,000, let's say, in profit. Okay. So it just depends on your membership percentage. And then I won't go into this one too much, but this is really, really the details, right? The name of the project, where it's located, the size. Down here is really cool. These guys do an awesome job with breaking out, month over month costs and month over month timelines. You can see all this here on the right side by unit. Down here, you can see the soft costs, which we had on the previous tab, broken out month over month. So this is more of the details that you would get into. And the big things you want to look at, like, Laura, you mentioned earlier, rent roll, expenses. How do I look at that? And that's a great question. You've got to understand that they're going to be projecting out year over year how the project's going to perform. And so if you're looking at rents, right, and let's say for the first year of the rents, they're going to say, hey, we're going to be at $1,000, just use a notional number on a unit for rents. Well, in the next year, if they say they're going to be at $1,500, that means that they're assuming a 50% appreciation for rents. I don't know too many properties that are appreciating at 50% year over year. Typically, we see about 3 or 4%. So that's something that you want to look at. That's something that you want to dig in on. But again, I don't want to get into this too much. Happy to talk to you about more offline. But this is kind of what you would expect to see in a pro forma. And then here's the breakout and soft costs. You could have a tab for hard. Some of these pro formas have 30, 40 tabs, and they're very overwhelming. So you got to do it in bite-sized chunks. You got to sit down and roll up your sleeves and try to put, it's like Tetris, matching things up to make sure everything aligns with the executive summary numbers, and that the comps and everything is also very much the same. Okay. So,
John, if we can just jump into the comments real quick. Kay has a
go
couple
ahead,
of questions
please.
related to Capital
Yeah.
Stack.
Yeah.
Kind of talking about what, if any, type of red flag is it when you see a sponsor kind of funding its own deal and paying itself a fee out of that?
Yeah, I mean, it's part of the cost. It's a project cost. I don't have a problem with that because again, they've got to get paid, and usually they will build that in as a project cost. So, Dave, let me know if you guys could the spreadsheet here. Can you guys see the spreadsheet again? Yeah. So if you look at these costs, right, this $46 million, that's got fees built in, and what you have to do as an investor is you got to locate those fees and take a look. If a sponsor is anything over 5%, gets me concerned. If they're giving themselves a 7% development fee, 8%, that's too high. If they're giving themselves a 3% or 4% management fee on a value add deal, that's a little high. So I usually look for between 2 to 5% on fees. Now, if there's 20 fees on there, yeah, there's a problem. Why are there 20 fees? There should only be like 2 to 3, maybe 4 fees max. But the typical fees we usually see are like acquisition fee, management fee, development fee, right? If they start putting things in there, just like if you're going to buy a car, rim cleaning fee, trunk fee, stuff like that, that should raise a flag just to see. But there's no problem with that. I mean, they've got to get paid and they pay payroll, and that's typically where it's going to come out of.
John, if I could, I'd like to address another question from Kay. Kay asked, are you finding it difficult to get permits for construction and the materials needed to complete projects on time? And what I will say, Kay, is that the supply chain has started to catch up. And from what I understand from guys that actually do this in the field, that's not generally the problem anymore. And then the permits question, that's a jurisdiction by jurisdiction question. For example, California could be 2, 3, 4 infinity to get a deal done, where in Texas and most jurisdictions in Texas, for example, you can probably show up and say, hey, I'd like to build this, and then they stamp it and say, hey, have fun. So it really does vary by jurisdiction.
Yeah, it does. I agree.
And I'll kind of jump in real quick too, John. I'll kind of flip that coin over, Kay. As Doug mentioned, yeah, we're not really seeing a whole lot of issues, delays and so on with permitting and materials and things like that. Where we are starting to see delays is really on the opposite end when it comes to stabilization. Given the current economy, rising interest rates, and so on, where we're starting to see some delays is, because interest rates are rising, money's more expensive. The big companies, big conglomerations that would come in and buy these apartment complexes, buy these condo complexes with the intent to run and manage them are kind of hitting the pause button a little bit. They're kind of, money's very expensive right now. So if you're looking to pay, 30, 40, 50, $60 million for a property, it's a whole lot cheaper at 4 or 5 or 6% than it is at 8 or 9%. So while we're not necessarily seeing a lot of delays on the beginning construction side, permitting, zoning, et cetera, we are seeing some delays at stabilization and closeout just due to the current economic conditions.
Spot on, guys. Totally agree. That's the biggest challenge right now. And also obviously with the interest rates, it's difficulty with financing because it's a lot more risk. There's a lot more risk out there. Valuations are lower because of the interest rates, but hopefully that kind of pauses now for a bit. We'll see how it goes. Any other questions that you guys are seeing?
One other thing I do want to throw out here as just food for thought. One concern I do have about the construction side is the labor constraint. I'm really kind of worried about how that's looking. A lot of the trades are aging out, and the transition to what that looks like in the future. That is one area I think moving forward I am concerned about.
Yeah, I agree. Labor's always a challenge. There are a ton of jobs out there right now, but just finding the right talent coming in and getting what you need is very important. And that's why, if you find a good sponsor and you find good deals and you got good asset classes, you want to have a sponsor that's got that track record of performing in those markets, right? Because, I mean, if you're going to invest in Charlotte, North Carolina, or, Greenville, South Carolina, you want to make sure you see sponsors that have been very successful and are doing more deals there, because they know those markets, they know the planning process, they know the permitting process, they've done multiple deals there before, so that should give you comfort. All right, any other comments or questions? Just the last part, and then we'll be kind of wrapping it up, is your legal documents. Usually you'll be able to get a copy of the operating agreement, but at a minimum, you should have either a private placement agreement or a subscription agreement that kind of covers the legalities, the overarching risk. It should cover, all the details of the deal. Every email that the sponsor sent you that you asked questions about, every piece of communication, everything on the deck, numbers, everything should be in that private placement. The private placement is going to be your governing document, your governing, legal document that kind of protects you. And about 70 to 75% of that document, the private placement, is covering risk, what could happen. And so, and again, it's done intentionally because it wants to make sure that you're aware of that and that you understand those risks. But the private placement, I'll show you one real quick that we have. It's pretty easy. Thumbs up, guys. You see that on my screen? Private placement, good. So this is going to give you a detail about what the deal is about, what's the offering, the maximum. But the big thing I want you to look at on this is one. I want you to look at this part here. This is the first part. And then this first part's important because it's kind of like the executive summary of the PPM. And so it's going to describe the business, what the business is designed to do, who the managers are, or the manager, the size of the offering, how the manager is compensated, which is very important, how the sponsor gets compensated. This is a huge section for you. How do I get paid? How's my returns work? And then your waterfall. This is a waterfall here. It explains how profits, how monies that come back to the company are distributed out to each of the partners, the members. So that's very important. Okay, that's first section. And then I'm just going to flip down just a bit. Follow with me. You've got your risk section. This is all risk. Starts up here, and so risk factors are probably, like I said, about 70% of the investment. And then down, what we do too on ours, just sorry, I know I'm floating around here. We usually do an org chart because we want to make sure our investors and that folks know how the organization is set up from, the company all the way down to the investors who are investing. Okay. And then the investment strategy is obviously important, but the last thing I want to show you is the investors return section, which is more of a breakout from that initial one I showed you, the first part, that just had a kind of brief description of how the investors are paid. But this is your investor return section. And this is really important because you want to know, hey, how am I going to make money on this project? So it should be able to tell you specifically how you make your returns, how the net profits and proceeds are distributed. We call this, again, a waterfall or a distribution schedule. How do I get my money back? And then one of the things we do at JID is we'll give you an example. We say, hey, if this is what we made on the deal, here's what you should expect to receive. If we invest in this project, we're projected to make X amount of dollars as profit. Using our waterfall, this is what you as the investor should make. Okay. And we do it with best ideal scenario, what we expect, maybe not as good, bad, and then ugly. Okay. So we want to make sure you understand from top to bottom how you're going to get your returns, okay, and protecting your money. So that's really important. Subscription agreement is just going to be the paperwork you fill out to formally commit for a project. And every company that you're going to invest with is going to have an investor relations group that's going to be able to walk you through a lot of the documents. But most importantly, get your questions asked. Make sure you make a good list of questions. And if you don't get past this first wave, then you're not even going to bother going through 2 through 4s, in my humble opinion. So, this really, again, is going to alleviate you having to really spend a lot of time on deals that just don't cut the boat. So with that, we'll wrap it up. We want to thank you for coming out. We've got our next part, which will probably be next month, on the distribution schedule. That's fun. I like doing that because we'll run some scenarios to show you how you get paid and how you protect your money, and questions to ask, and how to understand your money and how it comes out. So with that, we will call it a wrap and take questions, and happy to spend a little more time with you guys if you have anything.
And John, I did want to add, guys, I did drop the registration link for the following 2 because I am excited about John's idea of adding on a sponsor. That would be so much fun. I did drop the link in, understanding, guys, the dates are not determined. It will say a date in there, but disregard that. That's not the actual date, but the registration link will be the same.
Thanks, Doug. Yeah, I'd like to try to get 1 or 2 sponsors to come out, walk us through maybe 1 or 2 different types of asset classes, maybe a multifamily sponsor and a development sponsor. That way you guys can kind of see how they think from their strategies in those asset classes.
And a question from Kay here, I did see that we didn't address. Kay asked if there was bonus depreciation on build to rent. There is no additional or separate treatment. Whatever the bonus depreciation rules are for real estate generally, that would be same rules for build to rent. So whatever that current, I don't know that they've changed it. I think they were phasing out the bonus depreciation. I don't know if they added that back in. I haven't talked to Yona Weiss in a while, so I understand that's sundowning, but we'll see.
Good question. Anybody have anything else they want to add, or any other questions? Yeah, and if you got any deals you're looking at and you got questions about something in particular we can help with, just reach out. We're happy to do it. We're not experts, but I've seen hundreds of deals, and I'm happy to go through them with you. And,
another great question from the audience here. Do you recommend a good real estate attorney to review docs? As a recovering attorney, I will say, that's a great question. Sometimes for PPMs, if you're seeing a bunch of deals, that legal bill could add up quickly. So as soon as you're comfortable reviewing your own deals as an LP, I would say that's probably good. But early on, if you're just not comfortable and you want to have somebody look through it with you, I could see investing in that. But eventually you'll see so many deals that bill would add up quickly. So, despite my brother may not like this, my brother lawyers may not like it, I say this, but typically you want to get to a point where you're comfortable enough to at least get a good feel of your own PPMs.
Yeah, and another thing to ask is, if you're thinking about investing with a sponsor, ask them for some references that are close to home for you, maybe in the same state. If you could pick those brains on those references and say, hey, do you have any good attorneys? 9 times out of 10, people are going to say absolutely, because they want to, give you a good person, and they want to also, be the hero for that person as well. So not a bad idea, but usually it's state by state. So yeah, depends on what state you're in.
Yeah.
You're in
and
Virginia.
I agree, John. The networking is really, really huge for LPs. I think the more networking you do with other LPs, I know Andrew really has had a lot of great contact with other LPs, and that really enriches your understanding of what's going on in the marketplace.
Yep. Andrew's on as well. He's got amazing experience as both an LP and a GP. GP is a general partner. LP is a limited partner. So obviously, as an investor on a lot of syndications, you're a limited partner. If you're active, you're usually the general or managing partner. So a lot of experience on both ends there for this group. So, well, hey guys, we won't keep you. We're just at about an hour. We want to thank you so much for coming out today. And listen, don't feel overwhelmed, because I know you probably are. So first off is go back and feel free to watch the this again. If you're somebody that's been doing this for a while, hopefully it's a good refresher. And spread it, share it, and enjoy it. But it's a fantastic way to do well for yourself, have fun, make money, meet great people, and and to have fun.
Thank you. Have a good day, everyone.
Yeah, guys.
Thank you,
Thank
guys.
you. Thanks,
Hey, guys,
Neil.
anybody
Keith.
have you
Thanks,
got
Laura.
time for one?
Yeah,
You got time? Oh, I just wanted one quick question. Do you have an opinion on the rental market going forward? You know, I mean, we're seeing interest rates so high and then a lot of these properties are being built, you know, with the expectation of renting. Are we seeing the rental market to be better now with that, or do you have an opinion?
So it's funny. I shouldn't say it's funny, but we just had a call today with Jones Lang LaSalle, which is a pretty large broker, and we were talking to him about different markets, but more importantly, DC, because we've got a few properties in DC, Keith. And he said that absorption is actually pretty good, that occupancies are going up. The problem is that the interest rates are really hurting the cap rates on the valuation. So I was listening to a mortgage broker yesterday saying that his tea leaves are saying that the Fed's probably going to hold off on raising rates. So he said we just got to pray for a really crappy jobs report. So I think that would be the next telltale sign that if we see a bad jobs report, that may be an indication that things are slowing down a bit, which is a good thing. The other thing is you got a presidential election next year. It's going to all be, peaches and cream for most of next year. So if we do hit a recession, I think it's going to be in early 25, maybe mid 25. I do think there's going to be a lag with what interest rates are doing. So I think next year is going to kind of be, steady, still in kind of this fog. But as long as they don't raise it and things kind of stay a little bit steady, I think we'll be okay. Evaluations are the big thing I've been hearing about right now.
Yeah, and John, let me add, the Fed's own forecast show they're going to drop rates about a point next year in their own forecast. Now, what's really interesting, I think they're I think they're confused, honestly, because they think as much as they've raised it, they would have expected more unemployment. And so that's the kind of the caveat to everything is the unemployment rate is still really resistant to what they've done. Now it's softened and a lot of the slack is coming off out of the unemployment rate. But a lot of the unemployment rate as is, we're still pretty strong. So that's where they're kind of like I would agree they're concerned. And as long as we don't have a big unemployment drop though, or a big unemployment increase, then I think the rates will stay a little bit higher and longer. And so it's a really interesting thing to see how that transpires. But even the Fed's own forecast shows about a drop of about a point in interest rates over the next year or so, and then significant drops by 2025. So it's interesting to see how that plays out.
Yeah, and there's like $1 gajillion out there right now that's just waiting to come in to invest. I can tell you that right now. So if we see any steady or even a little bit of a rate drop, you may see an influx of cash come in. So that's good news. But at the same time, if it's premature, we're just going to be on the same roller coaster we've been on.
Yeah, it seems like Q1 might be steady as she goes, or kind of holding pattern, but then things maybe Q2, Q3 might open back up. I don't know, John. I'm just speculating and see how this will go, because we're finding the passive investor side is kind of hold the same thing you're noticing there, John. A lot of people on the sidelines right now, and a lot of people are like, well, yeah. And so I'm interested to see when the green light comes back on.
Yeah,
I think having dry powder, is what is the key. If something comes down, and maybe that's part of it. I don't know. That's my hesitation.
cash is king, Keith. It always is, and it always will be. Yeah, regardless of where we are in the cycle. I agree with you 100%. But now I think is a good time to have cash, because there's going to be a lot of distress. Every deal I'm looking at right now has got to have a story. I want to get it at 50% off. I want fixed rate debt. Whatever it is, it's got to have a sexy story for me to want to take a look at it. Because the deals that we were looking at 2 years ago at 3.5%, 80% leverage, floating 311, it doesn't work. It doesn't work anymore. So
Thank you, gentlemen.
You bet.
our pleasure. Thanks for staying on extra.
Yeah, thank you, John. It was awesome as always.
Yeah,
and Dave, I just
absolutely.
emailed you the recording link. So as soon as it's done recording, and it'll shoot, you'll be able to download that.
Okay.
Yeah.
Yeah. Thanks, Doug. I saw that. And I also saw the registration link for part 7.
Yeah.
So we're good to go.
Yeah,
And you guys have the updated slides, so feel free to share those with the group. Yeah.
absolutely.
Thanks, everybody.
Thank you, guys.
Have a good day.
Yeah.